Why most micro private capital portfolios are riskier than they admit. Introduction: the comfort of calling it diversified. Ask a micro private capital investor about portfolio risk and you will often receive a reassuring answer. There will be talk of diversification, downside protection, structured entries, sector spread, and strong alignment with management. And yet, if you look closely, not at the headline returns, but at the underlying exposure, many micro private capital portfolios are riskier than their owners care to acknowledge. This is not an accusation of recklessness. It is a comment on structure. Micro portfolios carry forms of risk that are subtle, concentrated, and behavioral. They are not always visible in models. They rarely show up neatly in risk matrices. But they are there. This essay explores where that risk hides, why it is underestimated, and why acknowledging it is the first step toward managing it properly. Concentration risk, the maths no one mentions. Let us begin with the obvious. Most micro private capital portfolios are small. A handful of investments. Occasionally a dozen. Rarely more. Each deal may represent a meaningful percentage of total deployed capital. A significant portion of expected return. A large share of time and attention. This is concentration risk by definition. In institutional private equity, portfolios are designed around statistical smoothing. In micro-capital, portfolios are shaped by opportunity and capacity. The problem is not concentration per se. Concentration can enhance returns. The problem is pretending it is not there. When one investment accounts for 25–40% of expected carry, the portfolio is fragile. When two underperform simultaneously, liquidity tightens. When three require follow-on capital, the cheerful tone in quarterly letters becomes noticeably subdued. Diversification in micro-private capital is often more narrative than numerical. Key person risk, the founders who cannot be modeled. Small businesses are frequently founder-dependent. That is not a flaw, it is a feature of how they grow. But from a portfolio perspective, this creates a specific form of risk that is easy to underestimate: key person dependency across multiple assets simultaneously. Consider the overlap. Several businesses led by strong, charismatic founders. Multiple companies reliant on individual sales rainmakers. Technical founders central to product development. Now imagine burnout. Illness. Personal crises. Fatigue. In micro-portfolios, such events are not isolated. They are correlated by scale. Small companies rely heavily on individuals. That reliance compounds across a portfolio. Yet underwriting often focuses on revenue concentration, not human concentration. Humans are not line items. They are volatility. Liquidity illusion, the myth of optionality. Many micro-investors comfort themselves with the idea that exits are flexible. Trade buyers exist. Secondary deals are possible. Dividends can be taken. In theory, yes. In practice, liquidity in the micro market is episodic, relationship-driven, and sensitive to macro mood swings. The risk is not merely illiquidity. It is illiquidity combined with concentration. If one asset needs refinancing during a soft market, options shrink. If two assets underperform during a credit tightening cycle, leverage disappears. If a planned exit window closes, capital recycling stalls. Micro portfolios often rely on staggered exits to generate momentum. When that sequencing breaks, pressure builds quietly. Liquidity risk is rarely visible in IRR calculations, but it shapes real-world outcomes. Follow-on capital risk, the polite escalation of commitment. Small businesses frequently require additional capital. Growth consumes cash. Transformation costs money. Mistakes need covering. Micro-investors often assume they can support follow-ons selectively. But reality intervenes. When you already own 30% of a company, walking away from a funding need is psychologically harder than declining a new deal. You are invested, financially and emotionally. This leads to over-allocation to underperformers. Defensive capital deployment. Escalation of commitment. The portfolio becomes skewed. Strong assets receive steady support. Weak assets absorb disproportionate attention. This dynamic rarely appears in initial portfolio construction models. It emerges gradually, driven by loyalty and loss aversion. Correlation risk, the hidden linkages. Micro-portfolios often appear diversified across sectors, services, software, manufacturing, consumer. But underlying exposures frequently correlate in less obvious ways. SME customer bases. Regional economic dependence. Similar cost pressures, energy, labor. Access to the same lending markets. A downturn in small business confidence can affect multiple holdings simultaneously, even if sectors differ. Because micro-portfolios are small, correlated stress can have outsized impact. Institutional portfolios mitigate this through scale. Micro-portfolios rely on hope and operational agility. Behavioral risk, the investor factor. The final and perhaps least acknowledged risk in micro-portfolios is the investor themselves. Micro-investors are more emotionally engaged, more reputationally exposed, more personally invested. Decision-making under stress becomes personal. Relationships cloud judgment. Optimism persists longer than it should. Institutional processes exist partly to dampen behavioral volatility. Micro-capital often lacks such guardrails. The portfolio may be structurally diversified, but if decisions are concentrated in one or two individuals, behavioral risk is amplified. Conclusion: risk is not a criticism. Micro-private capital portfolios are not flawed because they are risky. They are risky because they are concentrated, human, and illiquid. The danger lies not in the risk itself, but in underestimating it. Honest risk recognition leads to more disciplined capital reserves, clearer exit planning, tighter underwriting, greater emotional preparedness. Pretending the portfolio is safer than it is leads to surprise. And surprise is the most expensive line item of all.